Many traders have their favorite indicators, and these indicators become part of their trading strategy. But no matter what you hear, there is no best indicator or holy grail, because each trader's personality, psychology, and trading style will differ, and so their indicators will differ too. In this video, we're going to cover one of the most commonly used indicators that most traders use to decide on the trend of the different price movements, and these are called moving averages. It is often said that the trend is your friend. Being able to identify trends allows you to decide whether to buy, sell, or hold a position. However, determining the trend by simply looking at a chart can be very difficult. And this is where moving averages come in. A moving average is an indicator or tool that tracks price movements on your chart. Moving averages are used to determine the direction or trend of the price movements of your chart, and they smooth out the price action so that you can identify whether the trend is going up or going down. It also allows traders to identify possible entry and exit points. As the name implies, moving averages or EMAs don't plot the actual price for a given moment. They plot the average price over a period. As each new closing price is added, the previous one falls out of the calculation. Hence the term moving average, or MA for short. For example, a 200 MA will plot the average price of the last 200 periods on your chart. The length of each period depends on the time frame that your chart is set in. So as you can see on my screen, this means, for example, on a 1-minute chart, each candlestick shows price movement over 1 minute. So the 200 period MA is made up of the series of average closing prices for the last 200 minutes. And as you can see on this chart, it is a fairly flat line. On the same chart, a 50 period MA shows the price over 50 minutes. And as you can see on this chart, the line is more responsive to movements in the price. On a daily chart, the 200 period moving average shows a series of average closing prices over the last 200 days. The simplest way to use an MA is to plot a single moving average on your chart. When the price action stays above the moving average, it signals an uptrend, while if the price action moves below the MA, it signals a possible downtrend. The problem with using a single moving average is that this is way too simplistic. Let's say that the Euro USD has been in an uptrend, but a news report comes out causing it to surge lower. You see that the price is now below the moving average. You think to yourself, it looks like this pair is about to shift in direction. Time to sell. So you do just that. You sell because you're confident that the Euro USD is going down. As it turned out, traders just reacted to the news, but the trend continued and the price kept heading higher. This is known as a fake out. What some traders do, and what we suggest you do too, is plot more than one moving average on your chart, one of a longer time frame and one of a shorter time frame. This gives you a clear signal of whether your instrument is trending up or trending down. Once you have two moving averages plotted on your chart, the faster moving average, or the one over the shorter period, would be above the slower moving average. And in a downtrend, the faster moving average would be below the slower moving average. For example, let's say we have two MAs, the 10 period MA and the 20 period MA. On your chart, it would look like this. Through the uptrend, the 10 SMA is above the 20 SMA. As you can see, you can use moving averages to help show whether a pair is trending up or trending down. Having a number of MAs plotted on your chart helps you to confirm your trend. As trend traders, you want to recognize the trend and ride the trend for as long as possible, but you also want to know if the trend is about to change direction. As we know, some trends are short-lived, while others may last for days, weeks, or months. But you don't necessarily know how long the trend will last. It is based on many different factors. Moving average crossovers can help you determine where you think a possible change in direction may be occurring. A moving average crossover occurs when two different moving averages cross over one another. Because moving averages are lagging indicators, they won't pinpoint the exact time that the trend changes, but they will help you determine the bulk of the trend. A moving average crossover system helps you answer these three questions. Number one, which direction might the price be trending? Number two, where might a potential entry point for a trade be? And number three, when might a trade be ending or reversing? In order to use this technique, what you have to do is plot a number of moving averages on your chart and wait for a crossover. If the moving averages cross over, it might be a chance to either buy or sell, depending on which moving average is above or below. What some traders do is that they either close or open a position once a crossover has occurred. In summary, moving averages are very useful indicators for determining how long a trend may last, possible entry and exit points, and when a trend may start to reverse. Thanks for watching our video. If you have any questions, please send them through to us at fxscouts.com. We are very happy to answer any of your trading related questions.